Hey folks, it's Jeremy here, and in this video, I'm going to give you 7 reasons, 7, that's a whole hand and 2 more fingers, 7 reasons why investing in ETFs is better than individual stocks. Let's go. Hello everybody, it's Jeremy Whaley here from Trade Maestro. Hope you're doing fantastic today. You can check us out over at trademaestro.com. And in this video, I wanted to do a little bit of a breakdown of some of the reasons that I think ETFs are better than individual stocks. So I've called this video 7 reasons ETF investing is better than buying stocks. Now, here's the reality. Both ETFs and individual stocks have a great benefit, and I certainly trade both of them, and you probably want to do the same. It's really up to you. It's personal preference, but there are a lot of benefits to using ETFs in lieu of individual stocks, and certainly in lieu of mutual funds. And so I just want to go through some of that with you in this video so you have some of those ideas to think about. All right. So first of all, for those of you who may be new to investing or new to exchange traded funds or to ETFs, let me explain just briefly here what an ETF is. An ETF is an exchange traded fund. That's what it stands for. It's an acronym for exchange traded fund. What does that mean? Well, it's basically like a mutual fund, but it's going to trade on the exchange. Okay, so what is a mutual fund? A mutual fund is where you pull a whole bunch of people's money together and you buy a bunch of stocks, individual stocks, and now you own the fund. And if the individual stocks go up, then the fund goes up. And if the stocks go down, then the fund goes down. That's called a mutual fund. Okay, so an exchange traded fund, an ETF, is very much like a mutual fund in the sense that it owns and it holds a whole bunch of different individual stocks, but the difference is it trades on the exchange like a stock, okay? So instead of buying a stock where you're owning part of Apple or Microsoft or whatever company it is that you're buying, the company that is actually listed on the exchange is a mutual fund. That's essentially what it is. It's a fund that's listed on the exchange, kind of like a company, but instead of having individual products and services that it sells, the product is the ownership of other companies. Got it? So that's what an ETF is. An ETF is an exchange traded fund. It's like a mutual fund, but it trades on the exchange like a stock. And what's great about that is it has the benefits of both individual stocks and the benefits of mutual funds. So it has a little bit of both. And that's why I refer to ETFs as the mutual fund of the future. So let's get into my 7 reasons. There's probably more than 7, but I came up with 7 reasons why I think ETFs are better than individual stocks. Number 1, and really kind of the main reason, is diversification. Diversification. What is that? Well, you have to understand, if you are all invested in one company, that could be Apple, it could be Tesla, it could be Netflix, doesn't matter who or what it is. If you're all invested into one individual company and that company does bad, well, what's going to happen to your funds? It's going to go down. You're going to lose money on it, right? So that's why, the famous fund creator, mutual fund creator, Jack Bogle, he used to say, why try to find the needle in a haystack when you can own the whole haystack? Okay, so that was the idea of just owning a piece of everything. Well, that's what a fund does. A fund gives you access to the whole haystack. It gives you access to all the different stocks that you want to have access to in that particular fund. So instead of you having to go out and pick all the different stocks that you think are going to outperform, what you're doing is you're just buying a basket of stocks, and then as that whole basket does well, then you're going to benefit from that, okay? We call that diversification. So now you're broken up. Instead of having all of your eggs in one basket, you're diversified over a bunch of different individual stocks. And, for example, SPY has the S&P 500 in it, okay? So that's 500. If you have like the QQQ, that's going to have the NASDAQ 100. Well, 100 stocks is a little bit more stable than one stock, right? So that's called diversification, and that's really the number 1 reason that ETFs are very useful for us, okay? Because it gives you diversification over the individual stock. Next, second reason here is you get to avoid the earnings spikes. Every stock once a quarter is going to have an earnings report. And when you have that earnings report, it's very, very common that the trade will spike either up or down one way or the other. We call that a gap. But in layman's terms, it just moves a lot one way or the other. Well, if you're holding that trade, whatever that stock is, we'll just go back to the classics. You've got Apple, Microsoft, Netflix, whatever. If you're holding one of those stocks and you have a big gap, well, if it gaps in your favor, that's great. If it goes up $30 a share, fantastic. That helped you. But what if it goes down $30 a share? Uh-oh. Bummer. You just lost $30 a share. So that's the earnings spike. And that happens almost every earnings date, which is every quarter. So that's 4 times a year. Whenever you buy into a ETF, you're going to avoid that. Yes, the individual trade might have some earnings movement in there, and that could impact the fund, but it's not going to have the disproportionate impact that it would have if you had the individual stock. So that's the second reason, is you get to avoid the earnings spike. All right. Third reason is they are easy to understand. Easy to understand. It's not really hard for people to say, I understand that I'm buying into a fund that owns a bunch of companies. Like, that's pretty simple. At this point in human history, that's just a concept that most people understand. The idea of a mutual fund is pretty easy for most people to understand. You're putting your money into a fund where they've pooled money together and they're buying a lot of other companies. So that kind of makes sense to most people. It's easy to understand. And that's one of the reasons that the ETF is a really good vehicle. If you're trying to find that perfect company, and let's say that you're doing all your research and you found this company called Coinbase and you like the chart, it looks good, but you're like, they're a kind of a broker for cryptocurrency, and you just get confused. Like, I don't understand this company. Well, that can be overwhelming. The ETF is easy to understand. You can understand what they're doing. Their objective is really simple. We're going to buy XYZ, whatever these companies are that fit the performance that they're looking for, and we're just going to buy those companies. And so it's easy to understand. Another benefit, kind of along the same way of easy to understand, I probably should have done a different bullet point for this, but let's say that you don't have $500 a share to buy into one of these companies that you want to buy into. Well, you can put $500 into the mutual or into the ETF, and what you're going to get with that fund is you're going to get $500 worth of access to all of these companies. And so that's another easy to understand idea. Instead of saying, well, I'm going to go, figure out how to get my one share of Netflix, I'm going to get my one share of Amazon. I'm going to go instead buy into this fund that has all of it. And through that fund, I'll have exposure to Amazon, I'll have exposure to Netflix, and I'll have exposure to Apple and all these different companies. And it's just, again, it's easy to understand. So that's the third reason that I think ETFs are superior in some cases to individual stocks. All right, how about this one? Number 4, commissions. Commissions. Depending on your broker, this used to be a bigger deal than it is today. When I started trading over 20 years ago in the late 90s, if you wanted to place a stock trade, you had to pay a commission every time when you get in, every time when you get out. When I started trading, online brokers were brand new, and I started with a company that was offering $9 stock trades, and we couldn't believe how cheap it was. Most of the companies at the time were $25 a trade or $50 a trade, and those commissions, they add up really, really fast. Well, we still have commissions today, but most brokers have kind of gone to either very, very cheap commissions or no commissions. And you have people like Robinhood that have made it so they're getting paid on the back end from the order flow, basically. But they present it as though you don't have any commissions. With ETFs, a lot of brokers, if not most of them, are going to have no commissions on the ETFs. So that's really a beautiful thing. A lot of the individual stocks might still have commissions, but the ETFs, well, those are commission free. And so that's another benefit of working with the ETFs. You have lower commissions or no commissions that you're dealing with. So again, it may not be a big deal, but over time, that can really add up. All right, now here's a big one, I think. This is number 5 reason that ETFs are superior. They will not go to zero. They will not go to zero. I've been trading since 1999. That's when I placed my first trade. And in my 20 plus years of trading the market, I have never seen an exchange traded fund go to zero. I cannot say that for individual trades. In fact, how about I just take you on a little journey here, and I'll show you some that have gone to zero this year. Okay, not necessarily zero completely, but almost to zero. How about we come over here and take a look? I was just looking at some of these What about Meta? This is the company formerly known as Facebook. And did you know that Meta is down 75% since the beginning of the year? Well, technically since September of last year. Okay, 75%. It was just last September, this stock was trading at $384 a share. It is currently today below 100 at $95 a share. It's so low down here you can barely see it. Now that's not to zero, but who wants to lose 75%? What about Zoom? This was another one that's done this recently. Zoom, as in the online webinar platform. This is what Zoom has done. This is one of the ones I call the COVID stocks. Zoom during COVID zoomed, literally, peaking out up here at the end of 2020 at almost $580 a share. Wow, actually it was almost $590. And today it's trading for less than $100 a share. Wow. Those kind of things hurt a fund, but they won't take the fund out. Your fund's not going to lose 75% just because Zoom went down 75%. So that whole diversification idea is very, very beneficial because even if all the stocks go down, they don't go to zero. And I've never seen an ETF go to zero. I have seen trades go to zero. I've seen options go to zero. I've seen a lot of stuff go to zero. I've never seen an ETF go to zero. Okay, so there's a certain level of security and confidence that you can have with that. All right, and then my number 7 reason that I think ETFs are superior is option strike prices. Now, this may not mean a lot to you, but for me and for a lot of my students who like to trade options, this is a big deal. When you look at an individual stock that trades options, which is, I don't want to say most of them, but it's a lot of stocks today. There's certain strike prices that get issued, and those strike prices, they spread out the more expensive the stock is. So if a stock is trading between $5 and $25 a share, the standard issue for those strike prices is $2.50 each. Okay, so you'll have a strike price for your option that goes $5, $7.50, $10, $12.50, $15, and on and on. Okay, if it's stocks trading between $25 and $200 a share, then those strike prices go to $5 increments. So you'll have strike prices that are $100, $105, $110, $115, $120. Okay, so $5 increments. When you get over $200, they go to $10 increments. So if you have a stock that trades at $250, well, your strike prices, the standard strike prices, are going to be $250, $260, $270, $280. They're $10 increments. Well, what if you want something more fine? What if you want a smaller increment? Now today, as I'm recording this video in 2022, we have a lot of additional strike prices. When I started trading options, it was strict. It was exactly $250, $5, or $10 strike prices. Today, on the very heavily traded individual stocks, you can get additional strike prices. But with the ETFs, almost all of them, maybe it is all of them, I never verified that, but all the ETFs I look at, $1 strike prices. You can refine your option trade within $1. That means you can do an option spread that only has $1 risk on it. You can do, you can fine tune within $1. So you're not trying to buy a slightly in the money option that's $10 in the money just so you could get a little bit in the money. You can go $1 or $2. And you can really fine tune that because ETFs typically have $1 strike prices. There's a lot actually, that have 50-cent strike prices. So if you're an options trader and you're trying to fine tune your entries, you can do that so much more efficiently with an ETF than you can an individual stock. Again, I'm not saying that you have to do ETFs, but that's a really, really cool benefit of using the ETF because you have so much flexibility that goes with it. So that's just another one of the many benefits. And you know what? Like I said, I came up with 7. There's probably more than 7, but ETFs are a great tool. And that's why I like using them. We talk about them often in our Sunday night classes. And if you don't mind, I'm going to share with you something brand new that I have, which is a 3-day challenge called Raging Profits with ETFs. Raging Profits with ETFs. It's my brand new 3-day challenge. I'd like to invite you to participate with it. And if you don't mind, I'll tell you a little bit about it. On day number 1, I'm going to show you how you can beat the pros, beat the so-called professional traders. And I'm going to show you how you can do that with ETFs. I'm going to start by teaching you about the truth about fund managers and how bad it really is. I'm going to then show you the benefits of the ETFs, and it's a very simple risk on, risk off model of just simply buying and selling at the right time so that you can beat the market. And if that's all you get to experience from this 3-day challenge, it's going to be totally worth the investment of your time and your, all the effort that you put into learning. Just day number 1. But I know you're not going to want to stop there. You're going to want to go to day number 2, because I'm going to teach you how to diversify with the ETFs. Now, the ETF on its own is diversified. What if we could diversify even further? I'm going to show you how you can lower your risk with ETFs, and then I'm going to show you a very simple money management model that I've created where you can be in just 5 ETFs at one point, at any given time, just 5. So how cool would it be if you could simplify your trading down to just 5 exchange-traded funds, and each of those funds provides even more diversification? What if you could just get down to those 5 at any given time? That would be pretty cool, right? Very simple, very easy to execute, very efficient. And then in the process of that, I'm going to show you a very simple portfolio maximization model so you can really make the most out of market moves and avoid the biggest pain. That's day number 2, okay? Day number 3, what do you think you're going to get? Cash flow. Cash flow is king, right? So I'm going to show you how to make cash flow with your ETFs. We're going to start off by showing you how to make cash flow in a bear market, how you can actually make profits in a bear market when the market's going down, when everybody else is whining and crying because their accounts are going down. You're going to be, I don't want to say laughing all the way to the bank, but at least halfway to the bank, you're going to be laughing because you'll be making profits in a bear market. I'm going to teach you a technique where you can basically rent your stock, rent the ETFs that are in your portfolio, and bring in monthly cash flow from that. And then I'm also going to show you how to get paid up front, even if you don't own the stock yet. I'm going to show you how to get paid cash in your trading account that you can then turn around and use in the future to buy additional stocks. It's really powerful. You're going to love it. All right. So I truly believe this is certainly one of, if not the most efficient and profitable ways to beat the professionals and to manage your own money. And that's why I want you to participate with me. Now, what about the cost of this? Well, I could easily charge a couple $100, maybe $500 for this. But look, for you guys, because you're watching this video right now, it's absolutely free. All you need to do is register so that I can send you the emails. And in those emails, you're going to get the link to the videos for that day, whatever day it is in the process. And, if you missed the live session, then that's not a big deal. You can just watch the recording and you can review that. And, if you have any questions, you can just email us and we'll be happy to answer the questions. So easiest way, wherever you're watching this video, there's a link below where you can click to get registered. Or if you don't see that, then just go over to trademaestro.com, and let us help you get registered for the 3-day Raging Profits ETF Challenge. All right. Folks, thanks for watching. I hope you've really gotten a lot out of this. If you're not subscribed to the YouTube channel, get yourself subscribed here. Or if you're not watching this on YouTube, maybe you're on Facebook or another channel somewhere, another social outlet where we pass these out, then please subscribe, like, friend, whatever the term is on this platform that you're watching it on, so that you can get all of our updates and all of our stuff that we push out. And that's going to keep you up to date on everything, especially our market updates. So thanks again. Make sure you get subscribed. And if you're not subscribed over on our website, go over to trademaestro.com. Get yourself subscribed over there as well. All right. Once again, thanks for watching. I hope you've gotten a lot out of this. And until next time, happy trading. We'll talk to you soon.